Hi, folks. This is Mike Zlotnik, Big Mike, and today's discussion is going to be all about capital calls. What's the purpose of capital calls? And the most important question, whether to fund or not to fund a capital call that you may receive. Well, the usual disclaimer, main point is this for informational, educational purposes, no advice of any kind, no solicitation of any kind. Consult with your attorney and CPA professional before making any investment decisions. Any of our funds available through offering documents, PPM, to accredited investors only. And some of these projections and statements are obviously subject to uncertainty, future events, no guarantees of any kind. But let's just jump into crux of the presentation. So why capital calls are happening now and more coming in the future? So interest rates have gone up quite fast. And I just like to call it fast and furious. Fed was sound asleep for a substantial amount of time. Inflation got out of control. They woke up. They started to raise rates in March of 2022, and they went from about a 0 to a quarter target all the way to 525 to 550 in July 2023. They've kept the rates flat at this time of recording, and this is being recorded in early November 2023. So we've been flat since then. We'll still see if they do another quarter or not. It looks like they're probably done. Nonetheless, that change was just too fast and too furious. So what's the impact of the change? Well, let's go into many deals. So wide majority of value add projects in real estate have been financed with floating rate debt. Some took fixed rate, but most people don't take fixed rate in general because the thesis was to execute value add and refinance. If you take a fixed rate Fannie Mae, Freddie Mac project from the very beginning, there could be prepayment penalties and so on and so forth. So the most common practice was to finance with floating rate debt. Some folks bought rate caps, some folks didn't buy rate caps. We'll talk about that in a minute. So many deals have seen the interest rates on their mortgages more than double. And for example, could have started with the variable rate debt at 4.5%, and the increases that we've seen were approximately 5.25%, going from zero target, 0.25 to a quarter, to 5.25 to 5.5. That delta is about 5.25. 25% is a gigantic increase in interest rates in very short amount of time. And today's rate on the same mortgage is 9.75. So the payment factor is more than double. So that's creating a lot of financial pressure, which we'll cover shortly. Some deals bought rate caps, or rate caps is simply a form of an investment. And folks can translate it as an insurance policy. So in this example, where the initial rate was 4.5%, the sponsor could have bought rate cap at 6%. So all the increases in the rate cap in the interest rate increases over the rate cap are absorbed by this policy. So to make long story short, the project is experiencing interest rate only at 6%, no more. So from that perspective, these rate caps have provided a margin of safety for some amount of time. However, many of them are expiring. And either the sponsor didn't buy any rate caps, or they bought it and now it's expiring and no longer the protection from the much high interest rates exists. So a result of that, the payments either have gone up fast, or they have been protected by the rate cap, but now they are exposed as the rate cap is expired. Also, some fixed rate loans are maturing. Some deals were bought 3 years ago, 3-year term, and loan is maturing, and the interest rate in the loan resets drastically from where it was before to a higher rate right now. And also some deals are underperforming their projections. Occupancy, net operating income, and other factors are below the targets. As a result, incomes, cash flows are below the target, and the project needs more liquidity. So the capital calls is a mechanism, just to be very clear. What is a capital call? Capital call is when a project operator or sponsor or a fund manager, if it's a fund, so effectively needs to raise more capital, and they go to investors, and typically operating agreements allow for the sponsor or general partner to issue a capital call saying that we need more capital, otherwise we're going to run out of money. So these capital calls are coming in left and right as many projects beginning to experience liquidity pressures. So the significant uncertainty and high volatility of the outcomes of many projects. Why? Well, because there's a lot of uncertainty where some of the key interest rates are going to settle. So first of all, will inflation stay at the elevated level or come down to the Fed target range to the 3% on a long-term basis? Still unknown. The long-term interest rates supposed to be linked to long-term inflation. This is a general theory on 10-year Treasury yield, is that it's supposed to be approximately 0.5% above where the long-term interest rates settle down. But there may be a lot of volatility as inflation settles, and then there might be a few spikes in inflation. So overall, 10-year Treasury yield very much depends on where the inflation will settle. Will the 10-year Treasury drop down to 3.5% range or better, or will it settle in the 3.5% to 4.5% range, and or will it stay at the elevated level above 5%? A lot of uncertainty depends on this. And the cap rates, so cap rates are capitalization rates, not to be confused with rate caps. Cap rates are simply one of the key statistics that real estate deals trade at. So cap rate simply means that buyers demand certain rate of return on their investment. So for example, 6% cap rate on a project that makes $6 million would imply that the value of the project is $100 million. So cap rates simply state that you take net operating income, you divide by the cap rate, and you get approximate value. So if the cap rates expand, then investors demand more income per dollar of investment. If the cap rates contract, investors demand lower rates of return on the investment. And a lot of there's a long-term dependency on correlation between cap rates and long-term interest rates. So as long-term interest rates spike, the cap rates haven't kept up yet, and there's a lot of uncertainty where the cap rates will settle. And transaction volume is low today, so it's very, very difficult to know where exactly these cap rates will settle. So as a result, valuation of assets is highly uncertain in this environment, both today and hard to project future values. Why it's important? Well, because most of the times decisions whether to fund a capital call or not depends on where the future value of a project will be. And this point is very important, that if you can confidently believe in the future value, it becomes more difficult to participate in the capital call. Now let's talk about capital call participation logic. So to fund or not to fund a given capital call, right? This is a fundamental question. You get an email from the sponsor saying they're issuing capital call. Well, as an investor, you absolutely have every right to ask the questions to better understand what's happening on a project. And you can do your own due diligence. You can do your own comprehensive review. And the general partner or the sponsor better be cooperating. If they're not, then you get yourself a bad situation. And if they are very transparent and they are explaining exactly why they need the capital call and what's happening on a project, that is a good sign. At least they've done the analysis and review, and you can do your own and make a decision. So here's the process. Just again, not the only process, but some of the key elements of the review. So you would review project operating performance, look at financials. Is this underperforming its plan, and why? And really, why is the most important question. Why is it lagging the performance? And then the next question you are asking, how do you fix the problem? You certainly want to look at the economic versus physical occupancy. Is a big difference. If you have a bunch of apartments rented with people not paying rent, your economic occupancy will be substantially lower than physical occupancy. So an important consideration to know what's going on in the project. If it's sitting at high occupancy, but it's collecting rent poorly, well, there's a problem. You have to evict a bunch of people and figure out why the collections are bad. So an overall business plan, what's the business plan now to stabilize the project? This is very, very important. And if you can get to a point where you're comfortable with the plan, that may help you make a decision. what's the capacity of the sponsor or the operator and the ability to execute the plan. All those considerations are important. The other review that needs to happen is project financial review. What are liquidity needs? How much cash and what it's going to be used for? Sources of uses of cash. What's the path to get to a break even or better? Is there sufficient capital to get the project to a sale event or refinance event to generate break even cash flow? How long will it take? The project needs to be reperformed. So reperformed simply means re-estimated future projections of what the project will look like based on current assumptions on the business plan as well as on high interest rate environment. So what's something that looked good 2 or 3 years ago, today the assumptions may point to higher cap rates or lower pricing on a future value, and the project may not make economic sense, may or may not, depends. Can the project get a conservative exit pricing that justifies capital call? This is one of the most important questions. And what are the penalties for non-participation? If you choose not to participate, what happens? You just get diluted. If there's costs, people can't force you to wire in the money. If you don't believe you're putting good money or you're putting good money after bad money, you don't have to participate. Of course, consult with your attorney, CPA professional, what are the ramifications. But in most of the deals, operating agreement states that if you don't participate, somebody else will step in and you get diluted. But you need to understand what are your penalties for non-participation, if any. And most of the times you got to plan capital calls, especially if you have many investments. If you have portfolios of these investments, you need to review, understand your portfolio. And what you're trying to do is understand which projects are worthy and why, obviously, how much capital they need and when. And you have to understand the returns on the fresh capital. Meeting these capital calls need to be strong. Otherwise, why put good money after bad money? Project existing capital and returns of fresh money. So you're protecting existing capital in these investments, and you're getting a return on fresh money. These are very important considerations before making a capital call. Now, there's also opportunity cost consideration. If you support projects versus new deals, can the fresh capital make better returns than new deals versus existing projects? So if you're putting good money after bad money, you're taking that money away from the new deals participation. For example, this environment, there are a lot of great deals in the mass debt, preferred equity, that you can get strong returns. And if you take the cash away from those investments and you're protecting existing investments, you have to weigh pros and cons. And be clear on which projects are not worthy or unlikely to be worthy to participate in the capital calls. There are no guarantees. A lot of this depends on the future cap rates, but at least if you underwrite conservatively, you can get a pretty good idea whether a certain project is likely or not. And choosing your battles is very important because the capital needs to be prudent and smart in this environment, and throwing it at every capital call versus the best ones can make the difference between getting good return on your investment and suffering further losses. So I hope this makes sense, and appreciate your time and attention. And feel free to reach out if you have any questions on this presentation or other educational presentations. Reach out to Diana or me. If you're interested in any of our funds or syndications, request PPM. And we appreciate your time and attention. Have a wonderful day.